Hello everybody, Brian here from quantlabsnet.com. In this video on June 21st, we're going to talk about two separate portfolios that have been set up using the exact same data, real world data for futures and uh, options market. We've had our usual software that I build that will scan the markets in those spaces, in those asset classes, and it will do an analysis, and it will do two separate analysis, one for U.S. Assets that are to be included in one portfolio, and another comparison with a non-USA correlated portfolio. So this is the uh, article uh, that is part of doing the comparison. Um, and what this is that what we have is some kind of quantity stuff that's to be considered. Again, this is all generated by AI. The software I can present. These are the portfolios we're talking about. So this, as it says, it goes from raw data to actionable intelligence. So that means I can build out a trading strategies that will do live trading on a lot of popular brokers out there. The one I obviously focus on right now is Interactive Brokers. So we can do a lot of arbitrage, Um, but let's see here. We've got basis, the difference between cash price and the futures price on whatever. Kansas City wheat, $98. Gold could be another one. And then it will analyze the volatility rate between them all. And basically, the higher the volatility is more opportunity, but what happens is you have a higher risk of taking on losses. So we have the, as I said, the US-centric one. The big one right now, it's suggesting here that a Kansas City wheat at the BOS, which is a business basis opportunity score. So this AI will measure things we don't know about in the public space. Give it scores, give it correlation, the difference on the base on the future or the spot price, and it will go through it. So here, namely for the E-mini S&P, which is the bulk of the futures market, um, near zero correlation, significant red flag. So that means it can't calculate that correlation. Could be my data, could be the software or the AI. I don't know, but if it's not able to calculate it, it's something to take as it says as a red flag. So the one it uses is the wheat and the CL, the crude oil. And again, crude oil is considered U.S. based. Okay, and then we also have the E-mini as well, and then it will calculate the risk and the potential profit over the short term on that amount. So that's all fine and good. So now we can take the same thing and use a non-US correlated uh, portfolio, namely everything else outside of the US. That will include currencies. You can see here we're measuring the Swiss franc. We're also measuring the Brent Crude, which is international oil, not US based. And we're also now figuring out that the EA is actually figuring out high grade copper um, as well, and the Japanese yen as lower risk. So here, if we gave both portfolios $100,000, what would be the outcome? 45K to the Swiss franc, lower volatility, a safer bet. Same with Brent crude, along with copper and the Japanese yen. So that tells you that there's basically right here, this is more diversified than the US base. So this original one is more uh, concentrated. Okay, it's concentrated on U.S. agriculture. So if something happens to that space in agriculture, you're going to have a problem with your investments, right? So the portfolio is implicitly long the U.S. economy, but a severe recession could impact all three asset classes in a correlated way. Okay. So again, we talked about with any portfolio manager, you want to be diversified. This right here is not diversified. It's a high risk, high reward play on significant market dislocation. And the way the world's going right now, the threats coming from the president of the U.S., the uncertainties that come out of it, not including the tariff wars going on when the tariffs come off or the threat of them, we just don't know. So the question is, do you want to take that chance and do this exactly high risk, high reward play? Or is it better? And the conclusion is say the portfolio is significantly more diverse than the US-centric. Its returns are more sourced from the European currency markets, and the EU's or the euros kind of strong right now. International uh, international industrial demand and Asian monetary policy. So it might be better to take the U.S. sorry the international over U.S. Usually the U.S. will always outperform the international, but because of the national debt the U.S. has now, these threatening global war posturing, it puts the U.S. in a much more risky point of view. So that's kind of the conclusion there. I've got the two more deeper analysis to look at. If you become a member, obviously you'll get access to that. I can generate these type of reports all the time. So there's a specific one for the U.S., the other one for the international, and a deep one that compares the two and the risks and rewards of each and why it's better to go with one or the other. Obviously, you already know the situation there. I just want to mention that if you want to know more, all you got to do is come over to my website here. It says quantlabsnet.com. And in there, you'll find the Learn tab. You can also sign up here. Okay. And then you can also get, either way, under the Learn tab, a free C++ HFT ebook. About 500, I think close to 1,000 people have already downloaded over the last year. If you want to join what I'm talking about and getting things like that, just on the reports alone, you can join this. Here's the new shocking price of my programming one. There's a reason for that price. If you want to know, inquire away, but it's not that price publicly, yes, but privately, no. But yeah, so there's the offer if you're interested. Thanks for watching. Have a good day.